All right. I'm Justin Botillier, CEO of Calyx CPA, and today I've got my business partner Jamie, both beauty and brains, and the CPA in Calyx CPA. Thank you, Jamie, for attending with me to answer some of the questions that were left over from the Cannabis Business Times webinar that I did a couple weeks ago. And we got a lot of questions, and unfortunately, I didn't leave a lot of time to answer those questions. And fortunately, some of them are kind of hardball. So I thought, what better way to answer these questions than to have our expert or local expert.
All right.
I'm just gonna get rid of these, clear this question screen here. So why don't we just dive right in? So we answer people's questions, and we kind of ordered the questions that we received. We received probably a good 25 or 20 good questions.
Mhm.
So we're just going to dive right in. For those that hopefully you guys watched the webinar from a couple weeks ago, and I really just sped through a lot of information. Fortunately, this webinar or this presentation is about a 3-hour presentation that I cram into about 50 minutes. And so I expect there to be a lot of questions. So why don't we begin? Do we want to do the hardball question first, or do we want to do the question that we decided was like priority? So
Let's do hardball. Let's go
yeah,
hardball.
I like it. I like it when we get challenged by other accountants and whatnot,
Mhm.
and we regularly do. I was at MJ BizCon. We were at MJ BizCon, and I had another CPA yell at me in front of everybody, telling me that we were gonna get our clients audited and whatnot. It was interesting. And he didn't use that. He didn't use those words. He used a
Colorful
different
language.
exclamation that we were going to get his clients and then go ahead and fill in the gap. Okay, so let's see here. While you mentioned the IRS has not challenged the filings, can you admit that there is a chance of being audited? At
Mhm.
that time, do you truly believe the stance you are taking is defensible in front of the IRS? And
Yeah.
so that's a two-part question.
Yeah.
First
Can
is,
I jump into it?
yeah, well, yeah, I was going to clarify the question, but go for it.
Okay, clarify. Go ahead, clarify.
Okay, I was just saying it's a two-part question. Is there a chance that our clients can get audited? And then is our position defensible in front
Mhm.
of the IRS?
Yeah,
So,
I think yes to both of those questions. So yes, there's definitely a risk. I don't think we're shy about letting people know this is a risky position. It's a novel position, right? And we're trying to kind of bump up against the IRS so that they'll um, hopefully change the law. We believe the law is being interpreted incorrectly by the IRS. And so it kind of leads into another question, so it's going to be a good segue. But so do we think it's defensible? Yes. And so what Justin talks about a lot in his webinars is reasonable basis. And he says there's a reasonable basis for this position. But what that means, that's actually a really technical term in tax. And so there's levels of assurance with tax positions and tax returns. And they range from what's called a frivolous position, meaning it's not based in any authority. It's kind of a crazy claim. Like this frivolous positions are like taxes are unconstitutional, so I'm not going to pay them. Like it's that kind of thing. And then there's a reasonable basis is like the next step up. So it doesn't mean we think it's definitely going to win, but it means there's like a 20 to 30% chance. It's like more than frivolous is really what it means, which is generally kind of defined as like 20 to 30% chance of success. Um, but it means that it's like a bona fide argument. It's not just like a claim that's not supported by anything. And you can look to different authorities for a reasonable basis position. So you can look to IRS guidance, you can look to regulation, you can look to laws, court cases. And in this case, there is a pending court case right now, which is very helpful for proving there's a reasonable basis. But it's not a very clear-cut, easily defined term. It's up to interpretation to a certain extent, right? But in this case, we're looking to the law and how it's written. We have an argument about how that law should be interpreted. And we're that's backed up by a lot of official documents. It's backed up by the HHS report that says cannabis does not fit the meaning of a Schedule One substance. It's backed up by a lot of very solid information, and so it's definitely not frivolous. And that kind of and so when we say it's defensible, that's what we mean. Don't necessarily mean you're going to win. There's a chance you'll win. There's a chance it'll just not be looked at, right? There's probably the best chance it just won't be looked at. And then there's a chance it'll be audited and disputed, and potentially you will lose, but you will almost certainly be protected from penalties for taking that position. And that's what's really important about a reasonable basis and a proper disclosure of that reasonable basis. Is that it protects you from penalties. So then you're maybe just out interest on the underpayment of your taxes. The IRS will charge you interest. But that's a pretty, overall small price to pay for keeping, hundreds of thousands of dollars at your disposal for, several years probably.
And I'd like to add for those clients who we've gotten refunds for, the IRS will pay you interest.
Yeah.
It's been pretty nice to get, $100,000 for our clients and then another $25,000 or so in interest
Yeah.
on that
Yeah,
money.
it's interesting how they calculate the interest because they go back and if you file an amended return, they reduce the tax, and that's like as of the due date of the original tax return. So then if you had an overpayment that triggers an overpayment, then they calculate it as if that overpayment's been on your account since the original due date of that return. So that's sometimes 3, 4 years. And they'll also reduce any penalties that may have been applied originally for underpayment on your original balance or failure to pay on time. Any of those penalties will be reduced with an amendment. So I want to go to the kind of next question, which is the one we were maybe going to start with, which is saying that the IRS Cannabis Task Force is adding erroneous refund penalties. Um, that my understanding of what that's speaking to is frivolous, like frivolous positions and refunds issued on those what's considered a frivolous position. So assuming I'm interpreting that correctly, as I just mentioned, I don't believe this is a frivolous position. I have heard of those penalties. We spoke with a colleague, Nick Richards, who said he'd seen some of those penalties come through for clients. We haven't seen any of them personally. And so it's hard to speak to them. But we're pretty confident this is not a frivolous position. And if you were charged those penalties, we would absolutely dispute those penalties because there is a reasonable basis for this position.
I would imagine we could settle that through an appeals or through you'd
Mm-hmm.
have to go through some sort of process and but no, we've spoken to multiple lawyers and everybody agrees that this is not a frivolous. I think what it is like they may not have had like a proper A275 like included in the tax return. They're just doing a tax return without acknowledging 280E,
Mm-hmm.
or they're saying that, well, 280 has been rescheduled. I know that people, as soon as they said it was going to be rescheduled, some of the accountants were like, "Oh, it's rescheduled."
Yeah, there was like a
Yeah, there was
misunderstanding for some people.
misunderstanding.
Yeah, and so just to reiterate, with every return that we file, we include 8275s. It's the form, which is a disclosure form that, very transparently says exactly what we're doing. We say 280E, we say the exact amount of deductions we're taking that otherwise would be disallowed, and we include like a 3 to 4 page, legal write-up that, summarizes the position, the legal basis for the position. And that's true of our 471C position too. There are some questions that we'll probably get into about our 471C position, which is allocating some overhead costs to inventory. But we also file a disclosure form for that. And we're very, very transparent. So that's something I would encourage anyone, who's considering having their return filed this way or considering filing a return like this, we list cannabis right there as a product or service. We mentioned 280E by name, several times throughout the return. We file 8275s. We're not trying to hide what we're doing. We're being very clear about it.
And I'd like to add that again, attorneys are also doing the same thing through an opinion. They often will sell an opinion, which if you're looking for a pretty substantial refund, $1 million or something like that, then you may want to put out the extra money for an opinion from an attorney because it's more of like a historical write-up of the whole business, and it's just like kind of a novel versus our 3-page disclosure. It's more of like a 100-page disclosure. It's ultimately kind of the same thing, but some people feel like that holds weight, and especially if there's going to be an administrative review. What is it, like $2 million?
Yeah, $2
Like
million.
that,
I think
then
2 or 5, depending on
yeah, then
individual
then
or
your
corporate.
attorneys need to go up against their attorneys, and they actually meet and duke it out. But for smaller businesses, these 8275 Rs are well written 8275 R does the trick, and it's essentially the same thing. So it's not like we're doing this alone. It's not like we're the only people out there doing this.
Mm-hmm. Okay. Should we go to the next question?
Go for it. What would you think? What do you think is the next appropriate question would be? Do we want to talk about the 471 thing? Our accountant stated that 471C clearly
Yeah, we could talk
does not
about that.
apply. Go for it.
Yeah, so the question is, our accountant stated that 471C clearly states it does not apply to cannabis. Is this true, and have you had your clients audited? So that's a really good question. 471C itself, the law is a very simple law. So there's the code section that's considered the law, and then there's regulations. IRS issues regulations, which is like their interpretation of the law. It's intended to guide tax preparers, in using the law if there's anything that's not clear. And so 471C does not specifically mention cannabis at all. It's very short. It just, I'll shorten it even more, but it essentially says that if your inventory valuation methodology as reported on the tax return matches your internal books and records, so that means like your QuickBooks financials for most people, then it's considered clearly reflecting your income, and therefore it's a valid way to value your inventory. It doesn't say anything more than that. So it was intended to be it's a simplified methodology for small business taxpayers specifically, because inventory rules are generally very complex and they're very difficult to follow for small taxpayers. And there's a lot of rules about what can be included, what needs to be included as inventory, what doesn't, what, depending on your industry, you have to allocate indirect costs or you don't. This was intended to make that much more simple. And so there's no more requirements to 471C than that. It matches your books and records, and it's considered good, assuming you meet the, other requirements for using that methodology, which is your, $30 million or less in gross receipts. Um, and so then what happened shortly after 471C became, law, was that the cannabis industry was like, wow, this is great. I could put everything in cost of goods sold, and 471C lets me. And the IRS followed up with some regulations. And this was actually really interesting because there's like a governing body to the IRS, and they issue a report. I think it's annually, and they will specifically call out issues that the IRS should address, that they recommend be addressed. And 471C was one of them. They mentioned that, 471C does allow this loophole. That was the basically the analysis, the result of the analysis by this governing body. They said, this is really big. You should do something about this because this does allow, this is a way to circumvent 280E. And so then the IRS followed up with some regulations shortly thereafter that put this language that was like, any cost that would otherwise be non-deductible cannot be, considered an inventoriable cost because of 471C. I'm not quoting that exactly correctly, but that's kind of the crux of it. Otherwise, non-deductible. But what they didn't do was specifically call out 280E, which is really interesting after that report from it's called the TIGDA report. And it's pretty interesting that they didn't specifically call out the cannabis industry or 280E itself, because otherwise non-deductible can be a lot of things. There's meals and entertainment, there's personal expenses, there's things that are non-deductible in other parts of the code as well. Um, and um, so they said that, and then a lot of people were like, okay, we can't use it anymore. And that is valid. I think it's valid to think that, and many people did discourage the use of it. And so what we do for 471C is we file an even more kind of specific disclosure form called an 8275R, and that's saying we are taking a position that's directly contrary to the IRS regulations. Um, and that's because we don't believe that their interpretation of 471C is valid. We think they're overstepping. As we stated, the law is like quite simple. And we think that they are, that interpretation is essentially not valid. And so we file it anyway. And again, we disclose it very, very clearly on the tax return. And we file that form. The R is very important because a lot of people were like, they say 8275R, that's a request to be audited. That's like the joke. The R stands for request to be audited. We've been filing those since 2019, it must have been, um, with almost every return that we file. And we have not, I mean, we have not had
We've gotten no pushback from the
no
IRS.
pushback.
And knock on wood, knock on wood.
Yeah.
I want to add that this piece of information is extremely important
Hmm.
because it also shows kind of the behavior of the IRS in terms of it enforcing its own positions. Okay. Now, again, for the 471C position, we were not alone in this. We talked to numerous accountants and attorneys, etc. We have a little cohort of people we rely on. They, we agree that the IRS was putting in regulation that had no teeth because it wasn't found, its foundation was not in the tax code. And that is the highest level of authority, the tax code. And regulation, there's two things the IRS is supposed to be doing. They enforce the tax code and they interpret or they provide guidance when there's ambiguity in the tax code. Those are the two things that they're supposed to be doing. There was no ambiguity in the tax code in regard to 471C. And so therefore they took that, they did the regulation like a wet blanket on the industry, which it worked because everyone went fleeing away from the use of it. But ultimately, they never took it to tax court. They never disputed it. So we're in a similar position now with the no 280E approach. I used to, back when 471C, when we were doing these 471C returns, when this regulation was out, we were losing sleep. We're like, are we doing the right thing? This is scary. We're like telling the IRS to F off, essentially, with these 8275Rs. And ultimately, those fears never came into fruition, and we were able to aggressively mitigate 280E for years, even all the way up to now.
Yeah. And
So,
I
so
want to
it's just
add.
important to point out that, yeah,
Yeah,
go for it.
I think that's really important. I do want to add that an 8275R similar to this no 280E position now, an 8275R and the 471C position is also not, without risk. The regulations they do hold weight, right? They're one of the highest levels of authority. But what's important is that again, there's a reasonable basis for the position, and we believe there is for this one as well. And then not only is there a reasonable basis, but it's properly disclosed on the return. And again, what that does is it protects you, the taxpayer, as well as the tax preparer from penalties for preparing this return, because it could ultimately be considered incorrect, or the IRS could disagree with your position or dispute it. But if you're protected from penalties, then you're more or less just going to end up in the same position you otherwise would be in, right? So that's kind of the point of all this is one to share with you guys that we've had a lot of success with this and we haven't seen a lot of pushback, but also to help like the industry understand you don't have to proactively pay this. There's pay those additional taxes, right? You may ultimately still have to pay them at some point, but there shouldn't be penalties that amplify those taxes. And I also like to point out that this 8275R form is a form for a reason. It's okay to dispute the IRS. Like we are allowed to do that as taxpayers. And there's a whole form specifically made for that purpose, right? It's in R stands for regulations and it's for taking a position contrary to IRS regulation. So that's within the taxpayer's right to do, right? It's a matter of whether it's frivolous or not. And we've shared with you why we don't believe it's frivolous, right?
Just to be able to clear this question from an anonymous attendee, disputing our saying that it's going to protect us from penalties. He says, no, you are incorrect. The IRS is asserting erroneous refund penalties for these claims where the refund was never received, even where an 8275 included and a legal opinion. These are assessed penalties, so could be assessed before the opportunity for appeal or claim in court. So I guess what he's saying is there's agents out there that when these refunds go through the processing, and I heard they're happening in Michigan, it depends on what processing unit. Some of these people are assessing penalties. Listen, like the IRS is so underfunded right now, it's incredible. And when the Biden administration gave the IRS, fully funded the IRS $80 billion, there was a retirement spree. So all of a sudden, like a big portion of the IRS just retired all at one time. And then the IRS started hiring people back, all green, people who didn't know what the hell they were doing. And then Trump got elected, gutted the IRS again, and in 2025, their workforce went down by 30%. Okay, and that's reported by the IRS. So you got you got the worst of it. You got brand new people and their personnel decreased by 30%. They might be assessing penalties, but it's probably some intern who just doesn't know what the hell they're doing. Jamie, let's talk about that letter that we received.
Which one? There's many
Where
of them.
the amended return for the 1120 that they reported was an 11 or a 1041,
1041.
the state tax
Yeah.
return.
Yeah. I mean,
They
it's hard to speculate. I will say it's hard to speculate because we have not seen any of these penalties that, right? We've heard of them, we haven't seen them ourselves. So who's issuing them, what the basis
yeah,
is for that is
okay.
difficult to speculate. But I will say that especially over the past 6 months, we have seen an incredible amount of blatant errors by the IRS in not just in letters relating to or notices relating to maybe amendments for filing, just letters at all. There's typos, the year is wrong, the type of tax is wrong, the letter is wrong, it's the wrong letter. It's just kind of incredible how many errors we have seen. And so I do think that it's important to take that into account that sure, they might issue you a letter with a penalty, and if that penalty is not should not have been like assessed, then you dispute the penalty. You write them back and say, I'm not paying this, and I don't believe that this should have been assessed. And it's hard to say how every single case is like every single individual taxpayer's case is going to play out. We don't know. It's very dependent on IRS agent. You can appeal things like that, and you can go to the office, the independent office of appeals, and you can appeal, notices and penalty assessments. There are avenues to take, and if you're an unlucky taxpayer, you may have to jump through those hoops, and there could be costs associated with that if you need to, hire someone to represent you through that. There was a question kind of similarly about where did it go? whether we represent people. Um, let's read it. So this, do you want to read the question or should
Is
we?
it on Zoom or is it one of our
It's
ones?
on Zoom. It's anonymous
Oh,
attendee at 10:25. It's a pretty long one.
oh, him again. He needs to put his credentials in there because I don't want to let people like dominate this
Okay, well, I'll
conversation.
just speak to the kind of the crux of it. It's
Yeah,
they're
go ahead.
saying,
Go
you
ahead.
know,
He's
if you
asking good
file
questions.
the 8275, is it an acknowledgement to the IRS that you're willing to litigate your tax position, which is contrary to numerous federal tax court cases? That's what this attendee is saying. I'll start by answering that. No, I don't think you are saying that. I think you're saying you believe there is a reasonable basis for the position, and if they dispute it, you can just say okay, and you can then pay what they tell you you owe. You have no requirement to litigate by filing an 8275. They can just disagree and you can say okay. So if so, do you have an estimate of the fees it takes to challenge the IRS in appeals and or in federal tax court? Um, we represent our clients through appeals. We will, do our best to represent you through appeals. We don't represent, we can't represent in tax court, so we wouldn't do that. We would then have to refer you to. Oh, I lost the question.
Oh, I know.
Close it.
Accidentally. Sorry about that.
Oh, that's okay. I'll find it.
I cleared it.
Um, So we'll follow up. We'll write letters. We'll communicate with appeals on your behalf, and we'll do our best to represent you. No additional charge. That's part of our service offering.
Mhm.
Um, if you do need to ultimately hire an attorney, and we will recommend that if we believe that's in your best interest, at a certain point, right? Because we're trying to do what's in your best interest, then that is expensive. And I'll let Justin chime in here.
Yeah, yeah. I was gonna say, like, so far our experience has been that some of our the responses that we've been getting from these amended returns. So first of all, our experience with moving forward without reducing deductions due to the no 280 approach, because we think cannabis does not fit the meaning of a Schedule 1 substance, that has been going very well going forward. And
And
we
you
believe
mean by
that
that, just to clarify, you mean filing an original return,
an
not
original
amended,
return. So, and then we've been,
including those expenses.
yeah, and we have been amending returns, and that's what we're talking about now. And we've been getting two types of responses essentially. Most of them, the most of the amendments are going through. They're reducing deductions or reducing liabilities if they had an account. And in fact, we're filing returns where there are agents representing too. We're amending returns and whatnot. So we're going to see how those go. But what I was going to say is when they're asked to produce a refund check, there has been a higher in proportion, a higher response from the IRS that they're just denying it. They're saying, we don't agree. 280 applies until it doesn't, right? That's what they're saying. Okay. So from there, that's the worst that we have seen so far. And then the other thing is when when we want to go to appeals, when we request appeals, we haven't been hearing back from them.
Mm-hmm.
So we haven't actually been able to go through an appeals process because they're not responding to them because they're so overwhelmed.
Mm-hmm.
Ultimately, there's what's called, hazards of litigation settlement. We could potentially find ourselves in that position where they're like, hey, let's split the refund. Like, we'll give you half the refund as long as you don't like pursue this in tax court, something like that. Or there's the option to go to tax court. And now, otherwise, the worst case scenario is you decide you don't want to go to tax court. You're back at the beginning, less the accounting fees. We don't believe the penalties will stick if penalties have been assessed. We haven't seen that be assessed. That's not true for our clients so far. So ultimately, you could say, like, well, we tried through appeals, they didn't respond, or it didn't go through. You're back at where you were. You're
Mm-hmm.
not worse off than where you were before in
Mm-hmm.
that regard. Okay.
Yeah, that's been our experience, and I do want to also speak to some of the results we've had too, just to clarify what you were saying. So we've filed a lot of amended returns at this point. I think about 100. About 50% are still pending, right? So the time it takes to actually process the amended returns is a long time. The IRS recently issued a report, or Congress did something like that, it's like 13 months to process an amended return. It's a long time. And that's been pretty consistent. I mean, we've seen the longest one so far has taken like a year and a half to be processed. And the quickest has been a couple months. So it's kind of like all over the place. But most of them are taking a long time. Of the ones that have been processed, we've seen about a 70% success rate, meaning that they've been processed and they've either issued refunds or reduced a tax liability, based on the claim that we filed. We've seen about 12%. No, sorry, I don't have that number. We've seen the rest have been denied, and a portion of those have been just because the statutes of limitations were disputed. And then there's been a handful, the remainder that, as Justin mentioned, they've just said, we disagree. They just deny them, which is interesting. It's not an audit. It's not assessing penalties. It's none of those things. It's just saying we're just not going to process your return because we believe it's not correct. And those are the ones that, for our clients that have wanted us to, we've written, letters requesting an appeals conference, basically. And we have not heard back at this time. And that's not surprising because the appeals is just as underfunded and under-resourced as the IRS as a whole right now. So it's kind of where we stand.
And then just to go back to answer some of these questions from the original webinar, have our clients been being audited? Just to again, like to reiterate, and the answer is no, no, we've not. There's not been audits. So I'm not saying that it can't happen. It's just that right now, if you were to look at the number of audits we've experienced over the last 10 years, which has been 2 total federal audits, it's like statistically almost zero, in terms of the risk of being audited. So that is not something that I think ought to be, definitely be aware there's a risk, but not feared, feared of. And really, we've represented people in audit a lot, and agents tend to be pretty reasonable people. They just have you on their list of people that they have to get through. They just want to be done with it. So you have somebody who can represent you through the audit, who can get them what they want in a timely fashion and be friendly with it. They're going to just move you through, and there's not going to be a lot of fallout. Unless your books and records stink, then they might have a bloodbath with you. But I hope you're taking these aggressive positions if you don't have good books and records.
Yeah. And I think it's important to note that the audits that we have been involved in were triggered for unrelated reasons, returns prior to when we were taking these positions. We've experienced audits that have, trickled into future years, because that does happen with audits where they'll crack open the following years, but they've been unrelated to these positions. It doesn't mean that the positions don't ultimately, get looked at. But it's really is a very negligible amount considering how many returns we filed.
Yeah, and I actually think it may be due because the percentage of audit is actually much higher than what our firm has experienced. But I think even contrary to what other accountants say about the 8275, to me it looks like, hey, these are not low-hanging fruit. There's lots of low-hanging fruit in the cannabis industry. Like they don't need to fight a fight, and when you file a properly prepared, accurate return with an 8275 and 8275R, it looks scary even to the to the IRS themselves. Okay, I like this question here for I like it when they're asking for confirmation and they agree with us, right? I like for the public, okay. This is from Jason.
Is this in Zoom or?
Yeah, Zoom. For the public cannabis companies, Curaleaf, GTI, I've read that 7 of the top 10 have unpaid 280E balances in excess of 100 million. Do you agree that their strategy is aligned with your approach, or what else do they perhaps know that the smaller operator may not?
Okay, I do have some stuff to say about that. I think, and it relates to another question we got actually last time too, or from your webinar, about the difference between medical and rec.
Mhm. And I have
So,
something else to add to that too, but go ahead.
okay, do you want to go first?
No, you go first.
Okay. So there is, I think, some of the bigger public companies, who, especially the ones we know got refunds, they were, if not solely medical at that time, primarily medical. And I don't know, necessarily how that's changed going forward, but I will say that there is potentially a stronger argument for medical than rec in some kind of facets or in some of the arguments because there's several arguments why that are kind of in play as to why 280E shouldn't apply. One is kind of the CSA argument, interstate commerce versus intrastate commerce, and the constitutionality of that. That was what Canada Provisions was arguing and was hoping to get to the Supreme Court and have it heard at the Supreme Court level. And unfortunately, in December, was the Supreme Court declined to hear the case, which is interesting. And I think people should know that that's not saying they were ultimately the case was. Let's see how do I phrase this? They lost the case at the lower courts, right? And so ultimately they lost the case. But that's how it has to be because there was prior Supreme Court precedent, right? So lower courts cannot rule like against a Supreme Court precedent. They're totally bound by that precedent. They don't have like the authority to overrule that. So the only way for that case to win was to make it to the Supreme Court, be heard at the Supreme Court level, and then hope for a different ruling, right? That's a new precedent being set. Um, Unfortunately, that didn't happen. And it wasn't that they lost at the Supreme Court, it was that the Supreme Court just declined to hear it. And that's not uncommon. The Supreme Court gets asked to hear so many cases all the time, and especially the last couple of years, there's been an incredible amount of cases that they are involved in. Because there's been a lot of kind of longstanding precedent that's been being either attempted to or overturned over the last several years. So it's interesting in that they did lose, but it's I think another case could argue that position again. And if the Supreme Court would hear it, I still think that there's a good chance it would have been a different, they may have ruled in the taxpayer's favor. Or I guess it's not the taxpayer in this case, just they would have ruled in favor of the cannabis industry. So that's one argument. And that's a little stronger for medical. That interstate commerce is a little stronger for medical because it's kind of based on how the federal government has been regulating cannabis. And when I say has been, I really mean has not been regulating cannabis. Because the reason this prior precedent that was set way back in 2005 that said the federal government can regulate interstate, intrastate cannabis activity was based on a watertight, federal drug policy, and that allowing the states to regulate it would then interfere with the federal government's ability to regulate drugs across, the nation. That's no longer been the case, and there are numerous things the federal government has done that has clearly indicated it wants to leave the states alone, with their industries. With their state legal industries. So that's important. Medical is the one that has a little bit stronger there because there's a specific budget, what's called a budget rider, that prevents the federal government, the DOJ, from allocating any funds to pursuing medical marijuana, businesses, specifically medical. In practice, they mostly have not been pursuing, any of the state legal businesses. But that's why medical is a little stronger there. So they could be leaning on the medical aspect more, but we don't know. I don't, as far as I know, none of those, the positions are, public at this point, but people are speculating. The no 280E position, the within the meaning of that's the position that says cannabis is not within the meaning of a Schedule 1 or 2 substances, which is what we believe the stronger argument at this point. What's nice about that one is it's across the board. It doesn't matter whether you're medical or rec. It applies to everyone, the entire industry, and it's I think a really strong argument. that's really good for the industry as a whole. So sorry, Justin, you can add on now.
I think you covered that pretty thoroughly. Yeah, thank you. Thank you. Okay. Let's see here. I lost my questions. Let's move on. Let's see. Does IRS, do we have any on the old questions that we want to talk about? We had some ones that I felt like were really good and we probably should answer those.
Yeah, we can go back to those ones. I'll let you
Yeah.
decide.
What were your thoughts? I mean, a lot of them are kind of what we talked about.
Mhm.
Um, what are your thoughts regarding the risk of amending 2024, possibly 2023 to reflect the 280E expenditures? Again, there is a risk, but with a properly filed 8275, with a reasonable argument. And again, there is a court case
Mhm.
that has been taken to the tax courts that is going to be litigated on. And if you read that, it's a very well-reasoned argument. So Jamie said it had to be 20 to 30% reasonable chance of succeeding. This is much more than that. This is like the sky is blue and we all see it. We all see the sky is blue and the IRS is like, well, it's green. It's green until we say it's not green. And it's green until cannabis is rescheduled. And then all of a sudden, 280 doesn't apply and whatnot. You know what I'm saying? It's like, and there probably will be disputes. The IRS is going to definitely not roll over on this subject because can you imagine the shitstorm they'll be in if all of a sudden they said, oh, we got it wrong. I guess 280 didn't apply all these years. So they're going to push back.
Mhm.
What they'll probably say is something like, "Oh, well, Congress meant cannabis to be a Schedule One substance. They meant 280 to apply, et cetera, et cetera." But good Nathaniel Pollock's an absolute astounding attorney. He is going to push back on that. What did Congress mean by saying within the meaning of?
Mhm.
Like, and the tax court precedents that says Congress is required when writing law to use plain language.
Mhm.
If they meant for it to be 280
Scheduled
to
as.
assess to drugs that were scheduled as a Schedule One substance, it would have said classified as. That's
Mhm.
what it would have said. So the court has the requirement to look at that as well and read it the way it was written in
Mhm.
plain language.
And,
There's
and
court precedent to that.
have you shared, I'm sure you did, but have you shared that Nathaniel Pollock worked for the DOJ for like a very long time? So
No,
he
no, I did
worked for
not.
the DOJ for a long time, and now it's interesting because, now he's like fighting them, but he's got wonderful, very applicable experience here. And so he
No.
is the one that's, he's arguing this case, and we believe he's doing a really good job. We've yet to hear the response for his opening brief or his initial brief or whatever the official lingo
Yeah,
is.
the response from the IRS, we
Yeah, it
haven't
was
heard that
supposed
yet.
to be, in
January.
January, and they've pushed it back, but it should be soon, I
Should be
think.
here. It's
I
it's
think it's
gonna
in, I
be
think
this
it's this
month.
month. So
Mhm.
we're eagerly awaiting that. We do expect this to be argued for a long time. I mean, Nathaniel has mentioned he knows it will be appealed no matter who wins or loses, right? It's going to be appealed. But it's a very good argument. And one interesting thing about the case is that it applies to tax years, I think going back 21 and prior, 2021 and prior. And there is also an argument that 2023 and forward is a stronger position than before
Yeah.
2023 because that's when the HHS came out with its official recommendation to reschedule. And that's a very vital piece of the argument is that the federal government has issued a department, right, of the federal government has issued a very formal report saying exactly why cannabis does not fit the meaning of a Schedule One substance, and that or two for that matter, and that it recommends rescheduling, and then the rescheduling process started shortly thereafter. I think it was early 24 that
Mhm.
there was the official notice for a proposed rulemaking, which is the change, the rescheduling process.
Mhm.
Um, so I think to answer that specific question, which is thoughts regarding the risk of amending 24 and possibly 23, those years and forward are the have the strongest argument for amending and applying this position.
Yeah.
So it'll be interesting. I'm very curious personally to see if the IRS responds saying, well, 2023 is when it changes, and tries to
Mhm.
invalidate this ultra health position
Mhm.
just because it's
Mhm.
prior to that. But
Mhm.
we'll see.
And I love his argument. I'm going to reiterate it. I say it in the webinars and whatnot, but I love how he said that Congress absolutely intended on for 280 apply to businesses that are trafficking in substances that fit the meaning of the Schedule One substance. And I think when somebody asked a question about wasn't it designed for designer drugs that might have not actually been included in the classification
Mm-hmm.
of Schedule 1 or Schedule 2, and they wanted 280E to apply to that substance as
Mm-hmm.
well, even though it wasn't classified on
Yeah.
Schedule 1 as a
And
Schedule.
that the language leaves
So
that room for flexibility, especially if there
it
is a
throws a
drug that is
wider
in the
net.
process of being rescheduled, has been
Mhm.
identified as Schedule 1 or 2, but is in that, administrative limbo that we have with scheduling. 'Cause it takes time, right? To say, okay, you don't just get to not apply 280E for the year or two it takes for this administratively to be buttoned up. So that's
Mhm.
interesting
Mhm.
that it could
Mhm.
go both ways there.
Yeah, yeah. Well, Daniel Grosberg here says, does IRS non-challenge to the 8275R filing lead to acceptance after time? I think this is a good question because the answer is no. If they deny you can do an 8275R and you could, well, let's see, let me think of it. This is if we're filing, well, usually if we file an 8275R, um, we're taking an aggressive approach to mitigating 280E, and then and when your return is accepted by the IRS, it's accepted. It's accepted, and then it's the IRS's responsibility to either audit or dispute it somehow.
Hmm.
So when we're filing those 8275Rs, we're already saying, hey, 280 doesn't apply ahead of rescheduling, or we're using a 471C
Hmm.
approach, even though the IRS said in regulation, which is interesting. I'm getting off. I'm going to come back to something, but now when we're amending returns, okay, and we're amending for refunds or we're amending to reduce liability, if the IRS denies it, you have 2 years to do one of two things or one thing. Now they're not mutually exclusive, meaning you can go and request appeals, or you could take it to tax or you could take it to tax court. So I'm not putting that, I'm not saying that quite right. You can do appeals, you still only have 2 years. So this is kind of a problem that we're encountering is that if the appeals takes a year and a half, doesn't give us time to dispute their response or their denial, the statute of limitations is still live. So you could lose your ability to get that refund. The only solution is go to tax court or go to court, and that can be expensive.
Hmm.
We're working with attorneys, trying to find a good attorney. I mean, Nathaniel's available, but he's going to charge. And we're trying to find like somebody who can work with us and kind of do not a class action lawsuit, but something where he can like docket businesses. But so far, what we've received from the IRS has been mixed. Like of those refunds we've been getting, it's so strange. Some of them, like we'll do like 9 amended returns, something like that. Three will get refunds, cash refunds. Three will be denied,
Hmm.
and then they're still sitting on a few. That's what's happening with one example. And now our clients are like, well, I don't know if I want to go to tax court with these. Maybe we just got a lot of this money back. maybe we
Mhm.
just argue this later,
Mhm. And
Um,
so maybe we should
yeah,
talk about
yeah,
like
go
all
for
of
it.
the statutes of limitations that
Yeah,
apply. So
go for it.
when you file a return, an original return, you have 3 years from the due date of the return or the date that you filed it, whichever is later, to amend that return. And even though they're the same amount of time, there's a separate statute of limitations that applies to the IRS. The IRS has 3 years to assess additional tax on that return. And what's really interesting about the statute of limitations is that it actually, if you amend a return, and let's say you're amending it right up, against the expiration of your 3 year statute to amend your return, that doesn't extend the IRS's statute of limitations to assess additional tax, to audit that return and assess additional tax. They get like a 60-day administrative window to make sure they have time to look at it, like a reasonable amount of time to look at the amendment and then decide whether to, audit you or whatever it is, right? Um, but it doesn't they don't get another 3 years to assess tax, and that's really important because they could even crack open an audit, and then in order to they would need to, if they wanted more time to actually pursue the audit, what they'll do often is ask you to voluntarily extend the statute of limitations. And that's like a form that they send to you and you sign and accept or you deny. And that's kind of like up to you whether you want to do that or not. So that's kind of interesting. There's 3 years there. The IRS has with some exceptions. They can extend that 3 years to 6 years or like indefinitely. Indefinitely is if they're like that it was fraud, and so you don't get protected by statute of limitations. That's not what we're dealing with here. 6 years is for like what's called like substantial understatements, income, that kind of thing. Hard to say whether they would be, if we haven't seen them pursue that ever in our experience. Hard to say if they would be successful or not, because if we have very clear disclosures of what we're doing, I don't know that it would be considered a substantial understatement. So that's something, don't know. But I would assume 3 years is what you're looking at. And so if you file that 8275 with or without the R, then there's 3 years. It's not more than 3 years in our experience, but there maybe is a chance it could be 6 that they could go back and audit. And then so that's like statute of limitations with your original return. Then there's amended returns and denials of an amended return. And so that's what Justin was talking about. If you get a letter that says your amended return was denied, you have 2 years from the date that letter was issued to file a suit with the IRS and try to get your refund that you asked for with that amended return. And that 2 year clock goes and is ticking regardless of whether you work with appeals. And so we can go ahead and we can request a conference with appeals, and we can hope that they actually, process that and get in touch, and we can work with an agent. But as Justin said, if that's taking a long time, you might still have to file that suit to, even if you're actively working with appeals, you might still have to file that suit within 2 years. One thing that you may or may not have more success with if you're actually actively working with an agent is you can also request to extend that 2 year statute, just as the IRS can ask you to extend your statutes if they want to audit you. You can request to have the 2 year statute extended, but the IRS has to approve it. They have to have signed it, and you have to have signed it before the expiration of that 2 year date, or else it's not valid. So the 2 years are really strong statute. And you could lose the ability to claim that refund at that point, unless you decided to file suit.
Right on. Well, we have about 3 minutes before the end of the hour. Anonymous attendee who's been very good about challenging us has got another question here. I really appreciate that, actually, versus just exclaiming cuss words at us. Challenging us with challenging questions is important. That we've thrived off of that for 10 plus years now in the cannabis industry, and it always keeps us on the cutting edge. So we appreciate this type of thing, and always definitely send us any information that you have that counters our approaches, lets us know where we need to be diligent. So anonymous attendee said, are we concerned about the promoter rules? And so like, are we there? I don't know a lot about it, but I imagine for pushing loopholes, things like that, like tax shelters, there's penalties that could happen. The IRS could say, hey, you're a bad egg. That's for us to worry about though. And I'm not worried about this because this isn't a loophole. This is us interpreting the tax code the way the tax code is written. The IRS has acted above the law with the regulation they put out, trying to close loophole for 471C, which did not exist. There was no basis for them to do that. That was them actually acting above the law themselves. So yes, could they be punitive? And they could be like, hey, this Justin guy, he needs to go down. Yes, that is a concern. That is, I'm not going to lie, and we are concerned about those things. But this isn't a frivolous situation. This is us actually espousing the tax code the way it ought to have, been interpreted by the IRS, which they're not. They're interpreting it based the way they want to interpret it, not based on the actual tax code itself.
Yeah, I
So,
think the way that
yeah,
I see it really is that there's a lot of fear, right, around the IRS. There's a lot
yeah,
of fear in the industry. There's a lot of fear for professionals working in the industry because it's, especially accountants, very traditionally conservative, right? And this is, uncharted waters. And so what we want to do here is we want taxpayers to have all the information, to not just be fearful, and then to make a choice for themselves. And what we're offering to taxpayers is that choice. We're saying, if you so choose, we are willing to sign a return taking this position, because we believe, there's a reasonable basis for the position, and that's your right as a taxpayer then to take that position. There's a lot of professionals that won't do that because they're not willing to take that risk, and there is a risk to the professionals as well as the taxpayers. But it's interesting, our experience the last 6, 7 years has been really interesting because it hasn't been as risky, at least that hasn't, the risks, the fears haven't come to fruition as Justin mentioned. It seems our experience is that it's not as risky as it seems. It's not as risky or scary as a lot of, people might make it out to be. It is uncharted territory, right? So there is a risk. There always will be a risk. We're challenging current interpretation of law. I mean, that's what we're doing. So we want to, give taxpayers that opportunity, and we want to hopefully advocate for the industry, in the way that kind of we're equipped to do in our profession. That's it. You're muted.
oh, I think he answered it. Very good. Thank you. I remember the echo thing, so I like muted myself.
Hmm.
But so next week, I think on the 16th, I'm doing the webinar again with NJ Biz Daily. So if you want to hear this whole thing again, you can attend that. And I think we're going to have a whole slew of more questions that we can do another Q&A on, Jamie, if you're
Hmm.
willing.
Yeah, of course.
We're very
Of
busy.
course.
And so that will be available. Otherwise, you can contact us through our website. You can call our general line and talk to Nick, and he can schedule an appointment with you guys to visit with me. We really appreciate everybody who attended today. Again, it's like social justice, right? We're advocating. Yes, you guys pay us fees for filing these returns, and yes, it pays the bills, but I just feel like it's the right thing, and we're on the right side of history here. All right, namaste.
Thanks, everybody.
All right, how do I close this thing down?